Hello, class. We're about to get started on section 3.5, A Walk on Wall Street. This is on page 267, and our learning objective is to read information from a stock listing, calculate cost of buying stock, and profit or loss from selling, study the price to earnings ratio, and use it to analyze the value of a stock, and finally to calculate profit from a bond sale. Okay, now we come down here to the bottom. It says, as a shareholder in a company, you own part of that company. When a company makes money, it can choose to distribute part of the profit to its shareholders. This money is called a dividend. The stockholder receives a sum of money based on the number of shares of the stock that he or she owns. Sometimes, if a company doesn't make a profit or its owners or managers decide to reinvest the money into the company, no dividends are paid. So when choosing whether to buy stock in a certain company, one consideration is whether or not that company typically pays a dividend. If you own stock in a certain company, why are you entitled to a periodic dividend? And that is because you are a part owner and is entitled to share in profits. Okay. Now we go over here to the next page, to problem number 2. It says, describe any advantages or disadvantages of buying stock in a company that pays a dividend. Okay, so what I'm going to do, instead of writing advantage and disadvantage, I'm going to write pro and con. So the first thing I would do, one pro, is that the advantage, well, the pro of buying a stock that pays a dividend, you get money for owning the stock. The con is the money that is paid out could be reinvested to help the company grow. So if the money is given out, you cannot reinvest the money to help the company grow. All right. So we go down here. It says, besides issuing stock, a company can also issue bonds. Usually bonds are issued to raise money for the company for startup costs or special projects. A person who purchases a bond is really lending money to the company. The company in turn repays the owner of the bond its original value plus interest. As a general rule, bonds are a safer investment than stocks, but stocks have greater growth potential. Number 3, describe the difference between stocks and bonds. Stocks are ownership in the company. Bonds are debt of the company. Okay, now we come down here. It says stocks can be bought and sold on a stock exchange. The price of a stock, which varies from day to day, even from minute to minute, depends completely on the amount that investors are willing to pay for it. This can be affected by the profitability of the company, the economy, scandals, even global political concerns. Investors buy or sell stock through a stockbroker. Traditionally, this was an individual working for a brokerage firm, but it has become common for people to use online brokers, in which the investor initiates the buying and selling of stocks online. In either case, the brokerage charges a fee called a commission. for the service of having their representatives buy or sell the stock at an exchange. Bonds can also be bought and sold like stock. It says here, how can an individual buy stock in a company? Couple places: stockbroker, online brokerage, or direct. What are some advantages of investing in a stock market? Growth potential that leads to profits. And you become an owner of the company. Those are the advantages. Okay, so now we move on to the next page. And it says, when all is said and done, there are two ways to earn money from stocks: buying a stock that pays a regular dividend and selling shares for more than you paid for them. This means that investors are tremendously interested in the day-to-day price fluctuations of stocks, as well as indicators of how well the company is doing. A stock table is a listing of key information. Stock tables can be found in newspapers and online financial sites. The stock table shown below, generated at 10:37 a.m. on September 4, 2015, is for a company called Computer Programming and Systems, Incorporated. Let's see if we can make sense of this mysterious mass of numbers. Okay, so we have, well, let's just take a look here. It says at the top, we see the name of the company and the ticker symbol. This is the name of the company. This is the ticker symbol. The ticker symbol, well, it says here, this is a shorthand symbol assigned by the exchange that represents the stock. So if you're going to buy a stock, you don't need to type in the full company's name, just the ticker symbol, and then that company will come up. Okay, let's see. We can skip through some of this. It says if you can add and subtract, this makes the previous close price redundant. Note that the stock has gone up by a nickel. Okay, so the previous close, all you have to do is see this is the last price that the stock traded for the previous day. So that is the previous close. The open, just to let you know, when the stock market opened, whatever this particular day, this is the first price that the stock was bought at, which is $45.02. The bid is how much people are willing to pay for the stock, and then this times 100 would tell you how many people are willing to pay this price. The ask price is from the people that already own the stock. This is what they want and how many people want it at that price. The 1 year target estimate, this is what analysts believe that the stock is going to end up going to by the end of 52 weeks or the end of a year. The beta tells how volatile the stock is, and basically how much the price fluctuates. Now, basically, if the beta is close to 1, then the stock stability is similar to the rest of the market. So if it's close to 1, not over 1, or not equal to 1, basically lower than 1, that means that it's just as volatile as the rest of the market. But the lower it is, the better. Okay, now the earnings date, basically what happens is on the earnings date, that is when the company will disclose how it did during this time period, during that quarter typically. And then we have the days range. It gives you the lowest price that the stock traded for that day, all the way up to the highest price the stock is trading for that day. Now, the one thing that I need to let you know The days range. The lowest price is not necessarily the opening price. It can be that, but a lot of times it turns out not to be that. So I'm just letting you all know that. And then the 52-week range is basically what's the lowest the stock traded for in that year versus the highest it's traded for in the year. So the lowest was 43.24 and the highest was 64.86. Now we come here to what it says, the volume. The volume is how many shares that have been traded for this particular day up to that point. So in this case, it'd be 5,119 shares that have been traded. Okay, the average volume. Now the average volume provides a 3-month, and you see the average volume has the 3M, that stands for 3 months. The 3-month average of the shares traded. So in 3 months, the average daily amount that was traded was 96,911 shares. Now we continue on. We have a couple more: the market cap, price over earning ratio. We had an earnings per share and a dividend and yield. Okay, so with that being said, we are going to go over to the next page, but first let's go through the market cap. The market cap is the total value of the company. So basically, it's calculated by multiplying the number of shares by the current price. So if you take the market cap, multiply it by the current price, it will give you how much the company is supposed to be worth. Now, the price over earnings, or price to earnings ratio, we're going to study this a little bit more in detail a little later. So I'll get back to you on that. Okay, next, the earnings per share. This is the amount of money the company made for each share of stock that has been issued. So for each share of stock that's been issued, the company made $2.44, which is pretty good. Now the dividend and yield, basically the dividend tells how much a person would make on a dividend for the year. Now, dividends are usually paid quarterly, which is every 3 months. But what they would do is divide this by 4, and every 3 months you would get that value. Whatever this value is divided by 4, which would be about, what's that, 60, almost about 62, 63 cents, somewhere up in there, every 3 months. And then this tells you the percent, because what it does is take the dividend and divide it by the price of the stock, and it would tell you what percent that is. So that's basically it in a nutshell, but we're going to go over this a little bit more in depth with some of the questions we have here. Okay, number 6, what is the current price of the stock? So we got 87.27. That's the current price. What are shareholders trying to sell it currently asking for? So they're trying to sell it for $87.07. What do analysts predict the price will be in 1 year? So we'll go 1 year target estimate be $111.75. And of course, we're talking about this Facebook stock. Is this stock more or less volatile than the market as a whole? We look at the beta, it's less than 1. So it is basically a little less volatile. And the reason why I say that is it's not that close to 1. It's like almost 11% away from 1. So it's less volatile. Okay, it says, what's the highest stock price in the last 52 weeks? So we go to the 52-week range. The highest price was $99.24. Does Facebook pay a dividend to shareholders? If so, how much? Since it's n/a not applicable, we would say Facebook does not pay a dividend. Okay. Now we move on here to the next page. We got problem 11. It says use the market cap to find how many shares the company issued. Okay, so you got the market cap, which is 245.89 billion. Yeah, that's not million. That's the big B. So we have to do a little multiplication here. So we could take the 245.89 billion and multiply it by Facebook's current price, which was $87.27. All right, so we could take our calculator. We go over here to this Desmos calculator. Now, let's just multiply this out as 245.89 times 87.27. So this would be 21,458.8203 billion shares. All right. So this is how many shares was out there. But if we wanted to write this out in a regular number here, now billions, we have to look at how many zeros are in billion. Now we know in a million there's 6 zeros. So a billion there's 9 zeros. So we would have to move this decimal over 9 places. So it's 214588203 and then 5 zeros. Okay, I put one too many zeros. And this right here would be how many shares Facebook has outstanding. Let me see. This is billions, trillions, as we could say almost zillions. Like it's 21. We could say like, let me see. This is trillion. Yeah, it's quite a few shares here. And just to put it in its proper perspective, this right here would be, we know this is the millions, this is the billions here, and this is the trillions. So it'll be 21,458,820,300,000 shares. That is a lot of shares. Okay, so now, as previously mentioned, there are two ways to make money from stocks. Buy shares of a stock that pays dividends, or buy stock at a low price and sell it at a higher price. But of course, you can't just go buy stock at the corner store. You need to use a brokerage firm, placing an order, which is then carried out by representatives at the stock exchange. In exchange for that service, the broker charges a commission, which varies among brokers. Brokers can also make recommendations concerning what stocks to buy and sell, which further justifies their commissions. The amount that an investor receives from the sale of a stock is called the proceeds. The proceeds are equal to the amount of the sale minus the brokerage commission. Next, we'll look at some examples of buying and selling stock. Shares of Apple Computer closed at $12.89 on April 1st, 2004. Suppose that an investor bought 600 shares at that price using a broker that charged a 2% commission. Okay, so let's take a look at this. Now, of course, we have to take into account that Apple traded that low. It was kind of a low point in its company's history because it's trading for a lot more than that now. So we had $12.89 times 600. So we'll put that in our calculator. So that would give us $7,734. Okay, now we want to find out how much commission was paid. So this is how much was paid for the stock, but the commission is 2% of this. So we would take the 7,734 and multiply it by 0.02. So that's 7,734 multiplied by 0.02. So our commission is $154.68. That's how much we paid in commission. Find the total cost of buying the stock. So the total cost of buying the stock is the price of the stock plus the commission, which is $154.68. So it'd be $7,888.68. That's the total cost of the stock. Now, it says here that a stock split occurred. A stock split occurs when a company increases the number of outstanding shares. Most commonly, this is a 2-for-1 split in which the number of shares doubles. This can be done for a variety of reasons, but the simplest explanation is that when the price of one share gets particularly high, it tends to scare away smaller investors, and the split effectively halves the price of one share. In any case, the net result is that in an instant, the number of shares owned by shareholders doubles. Apple did a 2-for-1 split on February 8, 2005, then a 7-for-1 split on June 9, 2014. How many shares would our investor have owned after the second split? Okay, so the first split, remember, our investor has 600 shares. They did a 2-for-1 split at first, so we'll multiply this by 2, and that'll give us 1,200 shares. That's with the first split. Then they had another split, 7-for-1. So we will have to take this and multiply it by 7. So that would be 8,400 shares. So our investor will have 8,400 shares now. Okay, so now it says our clever friend, the Apple investor, could have sold her shares for $130.28 on June 1st, 2015. If she had done so using a brokerage with a 1.5% commission, what would her profit have been? Remember, profit is the difference between cost and final proceeds from the sale, which would be selling price minus commission. Needless to say, you should show your work. All right, so we're going to take this step by step. First of all, she has 8,400 shares now. So 8,400 shares, and the price is $130.28. So we're going to multiply that real quick. So we have 8,400 times $130.28. So this will be $1,094,352. Okay, now it says here, she said that she used a brokerage with a 1.5% commission. So we have to take out that commission that would that's there as well. So let's take a look at the commission. It's 1.5%. So we can multiply this by 0.015. So we have 1,094,352 times 0.015. Okay. So the commission would be $16,415.28. This would be the commission. Okay, now, if we look at everything that this person paid, we have to subtract out everything that this person paid in order to get the total profit. So, first of all, on this page, we know they paid this $16,415.28. But then there's another subtraction that we have here. If we go back to the previous page, 271, remember they paid $7,888.68. That was the cost of the stock and the commission as well. So it'd be $7,888.68. Okay, so when we subtract this out here, we are 1,094,352 minus the $16,415.28. So that will leave us $1,077,936.72. Now we need to subtract that $7,888.68. So that leaves us $1,070,048.04 profit. Not bad. Let's see, that was 2004 to 2015. So in 11 years, they made over $1 million of profit. That was not bad at all. Okay, 16. How much money would our investor have saved by using an online trading site with a flat commission of $19.95? So this is what we would need to do. We would need to take the commission from the sale, which is $16,415.28, and then the commission that was collected from from buying the stock, which is $154.68. And we would add these together. So that'd be $16,569.96 in total commission. Now, they asked us how much we would have saved if we had used a flat commission of $19.95 per trade. So, it's $19.95 to buy and $19.95 to sell. So if we did that, it'd be $39.90 that commission would be to buy and sell. So if we subtract $39.90, you could have saved $16,530.06 in commissions. That's a lot of money. Yeah. So that is a lot of money, especially if you were buying and selling, based upon what you were saying and not the advice of anyone from the company. So you would have saved quite a bit of money. All right. So now we go here to the next page. Now we come here to the price to earnings ratio for the stock. The price to earnings ratio, commonly known as P/E ratio, is a key indicator of how reasonable the current price of a stock is. It compares the selling price of the stock to the annual amount of money the company has earned per share. If the price over earnings ratio for a certain stock is 20, that means that the current selling price is 20 times as high as the earnings per share. This tells us that for every dollar you invest in a company, that company will earn a nickel. Price over earning ratio can be a little tricky to interpret. On the one hand, a lower price over earning ratio indicates that the stock is priced reasonably, as you need to invest less for the company to make a certain amount of profit. But if investors believe in the growth potential of a company, they may be willing to pay a premium for the stock, which will result in a higher price to earnings ratio. To help get some perspective on price over earning ratio, it's useful to do some calculation. First, a formal definition. So we have this formula here. Price over earnings ratio is the current market price divided by the annual earnings per share. All right. For the Facebook stock table from earlier in the lesson, calculate the price over earning ratio using the current price and earnings per share compared to the price over earning ratio listed in the table. Why do you think they're not identical? Okay, so we're going to use the price to earning ratio, which is, and I'm going to abbreviate, the current market price all over the annual earnings per share. So we need to go back to page 270. The current price is listed up here, which is $87.27. So let's put that there, $87.27. And then the annual earnings per share. So we have to do the earnings per share, which would be 98 cents. So we divide that by 98 cents. Now, we put this in our calculator. We have 87.27 divided by 98 cents. So that would give us $89.05 when we round to two decimal places. Now that's the price over earnings ratio. All right, so basically now the table, if we look back here at the table, at the Facebook stock, price over earnings ratio is 88.69. So the table says PE ratio is $88.69. And this could be a rounding error or the PE ratio has not been updated. Okay, it says not every stock table you will encounter has quite the wealth of information that the ones at the beginning of this lesson have. A more abbreviated table might have the price over earnings ratio, but not earnings per share listed, in which case you could rearrange the above formula to calculate earnings per share. On September 8, 2015, Google stock closed at $600.70, and the price over earnings ratio was listed at 28.31. What was Google's earning per share for the previous year? How does it compare to Facebook? Which do you think was the better investment at that point? Okay, so now we have the price over earnings ratio, which is the current market price divided by the annual earnings per share. Okay, so the current market price, well, they tell us the price over earnings ratio is 28.31. So we already have that. Now, what was Google? Now it tells us that the current price was $600.70, but we're trying to find the annual earnings per share. So we don't know what that is. So now what we need to do, I'm going to rewrite this, and I'm going to replace the annual earnings per share with X to indicate the unknown. So we need to get rid of this X out of the denominator. So we'll multiply each side by X. So this becomes an algebra problem. So it'd be 2831X is equal to 600.70. Because you know these X's will simplify out. Now, we divide each side by 2831. We could put that in our calculator. So it'd be 600.70 divided by 28.31. So it'd be 21.22. So X is 21.22. Okay. So basically, they asked us the annual earnings per share. This is much higher than Facebook. So Google is probably the better buy. All right. Now we go here to the back. And we're actually almost done. We have about, aside from this page, we have 2 more pages after this. It says the table below summarizes some basic rules of thumb when it comes to interpret the price over earnings ratio for a stock. Remember that the best approach is to compare a stock's price over earning ratio to other companies in the same industry, as current market conditions can have a pretty profound effect on price over earnings ratio. So if you look here, we have the different price over earnings ratios, and then they have what each one of these actually mean. Okay, number 3, come up with some ideas why the Facebook price over earning ratio might have been sky high in September of 2015. You might want to look up the history of Facebook stock on the internet. Okay, first of all, many people felt the stock was overpriced because it had just gone public. And had such a big name. People were overly excited about it. And when people get overly excited about a stock, a lot of times they will pay a lot more than the stock is actually worth. All right, now we come here to the bond investing. It says when an investor buys bonds, the investor is actually loaning money to the company or government entity that issues the bonds. In exchange for lending that money, the investor will receive a fixed return on his or her investment for a given period of time. The ending value of the bond is called the face value. This is typically $1,000 but can vary. Bonds also have a maturity date, which is the date that the face value is returned to the investor, as well as interest. In some cases, no interest is paid until the maturity date, at which time the full amount of interest is paid. Coupon bonds, on the other hand, pay an annual or semi-annual interest payment known as a coupon. Okay, we'll get through more explanation as we go through problem number 4. It says, suppose that you buy a bond with a face value of $1,000. So that's some key information. That was originally issued 18 months ago. The maturity date is 4 years from the time it was issued. So the maturity date is 4 years. And the interest rate is 4% simple interest per year. If you pay $820 for the bond and keep it until the maturity date, what is your profit? What percent return would you get per year? Let's do some calculating. Okay, number 4, find the amount of interest that you will be paid on the bond at maturity and the total amount of money you'll get from the issuer at that point. You'll want to reach back into the archives and use the simple interest formula. So we do the simple interest formula, which is principal times rate times time. Remember, the face value is $1,000, earning 4% each year, and then it's for 4 years. So the total amount of interest on this bond is $160. That's if you bought it for $1,000, and then you got the 4% interest for 4 years. So you had $1,000 face value plus the interest. So when the bond is cashed in, it'll be worth $1,160. So that'll be the total received. That's how much the person will get for the bond when they turn it in. All right, now we go here to the back. Find the profit you make on the transaction. So remember, the total you would get is $1,160. But you're told here that you actually paid $820 for the bond. So it's $820. So that means you made a $340 profit. Okay, now it says what percentage of your investment is the profit made? So if you take the $340 that you made in profit divided by how much you paid for it, that will give you 0.415 or 41.5%. And you can put that in your calculator, which is fine. 340 divided by 820, which will give you approximately 41.5%. So I put this approximation symbols here. Okay, number 7. If you divide your total percent return for question 6 by the amount of time and years that you hold the bond, you'll get your percent return per year or annual return, which is a key indicator of how well an investment performs. A long-standing rule of thumb on long-term investments in the stock market is that you can expect annual returns in the 6 to 7% range. How would this bond investment compare? Okay, you have 4 years. That's how long the bond was. But you bought this bond 18 months later, because it tells you that here. You bought it 18 months ago. So you would subtract off 1.5 years, because we know 18 months, 12 of those months is a year. You have 6 months left over. So that's 1.5 years that you would subtract off. So that means that you actually held the bond for 2.5 years. So you would take this percent, this 41.5%, and divide it by 2.5 years. Now, we can take our calculator, take 41.5 divided by 2.5. And that'll give us 16.6% per year, which is an excellent investment. So I tell you, the banks right now, even with like 1 year CDs, is paying less than 1%. So if you're able to get 16.6%, that is very good. Now, as I look at this, I believe we can start 3-6. We could start it. I'm not sure if we would actually finish it, but we can actually start 3-6. So 3-6 starts on page 283, and it's called a taxing situation. Now we're going to deal with taxes. Now, this section, and I will tell you all this section is not that long, but it does have some problems that are long. So let's look at our learning objectives. We want to understand why we pay taxes, explain the basic process of paying taxes, determine the amount of tax due based on taxable income, and complete a 1040-EZ form. Now, we're not going to complete the 1040-EZ form, but we are going to go through a couple things related to taxes. Okay, so we go down here to the bottom. It says if you earn a paycheck through the process called withholding, taxes are automatically taken from the amount you've earned. The amount of tax that is withheld is based on two main factors: how much you earn and paperwork you fill out through your employer describing how many other people depend on you financially. The intent is to estimate the amount of tax that you will owe at the end of the year and pay some of it during each pay period so that you don't end up with a big bill that you can't afford to pay at the end of the year. When it's time to file a tax return, you'll find out if you paid too much, which entitles you to a refund, or too little, which means you need to pay more. Our tax system is designed so that people that make more money pay a higher percentage of their income in taxes than those who make less money. The range in which your income falls is known as a tax bracket, and the bracket you're in will determine how much of your income you will owe. It's essentially impossible to understand taxes without understanding tax brackets. So that's where we'll begin. Okay, now I have to warn you, since President Trump signed into law, I believe it was in 2017, the new tax brackets. These tax brackets here are actually obsolete right now, but what we're going to do, we're going to use them in order for us to bring this point home. All right, there are 4 different filing statuses. Single, which is self-explanatory. Married, filing jointly, which is when a married couple files a single return for both. Married, filing separately, which is when married individuals decide to file separate returns. And head of household, which is for unmarried individuals that financially support others. There are different income levels that qualify you for certain brackets depending on which filing status applies to you. Below is a table of tax brackets for 2014. Now, for each filing status, the range of incomes listed in that column determines which tax bracket an individual falls into. For example, notice that in the second row of the married filing separately column, the range is $9,076 to $36,900, and the row has 15% in the tax rate column. This tells us that a married taxpayer filing separately with taxable income between $9,076 and $36,900 and the 15% tax bracket. In a while, we'll study exactly what that tells us about the amount of tax he or she would pay. If a person filing as single has taxable income of $42,000, what tax bracket is she in? So filing single, so we look here at single, and the income of $42,000 will fall here in a 25% tax bracket. So for single, it'll be 25%. Now, what about a married person filing jointly? So married filing jointly, I abbreviate that. So we'll go married filing jointly, and we're going to 42,000, which would be in a 15% tax bracket. Now for the big question. how much would that single person pay in taxes? If you said 25% of 42,000, that's a fine guess, an incorrect one, mind you, but a fine guess nonetheless. So what's the deal? What does the 25% tax bracket mean? Ensure all taxpayers that are single pay 10% on the first $9,075. They then pay 15% on the next 27,825, which is the amount that falls into the range of 9,076 to 36,900. Finally, they pay 25% on the amount over 36,900. Okay, so now we move on to the next page. It says, using the information just provided, calculate the amount of tax that our single person would pay on income of $42,000. Okay, so now we're going to use this tax table here. I'm going to have to be very careful in how I set this up. Remember, this person is single and they $42,000. So this is what happens here. We got to go through each one of these tax brackets, but we know we're going to end at the 25%. So we know at the 10%, we would take the highest value, which is $9,075. So it's 10% of the first $9,075 that is made. Okay, plus, now we go here. We know that we're going to take care of everything in a 15% tax bracket. So what we would do, we would take the largest value here, which is $36,900, and subtract off what we paid in the 10%, which is $9,075. So that would take us to the 15%. Now let me explain why we do the subtraction here. It's because if we just put $36,900, we would be getting taxed on this $9,075 twice. That's why we're subtracting it out. Now we go here to the last amount here. Now we know we're in the 25% tax bracket, and we know this person earns $42,000. So we would take the $42,000 that this person earned and subtract the $36,900 that we used previously. And we'll multiply this by the 25%. Okay, now let me explain to you why we use the 36,900. Because remember, between the 10 and 15%, we covered the first $36,900 of income. So that is why that has to be subtracted out here, because we don't want to get taxed on that twice. So now we will put this in our calculator. Just get a little space here. Ooh. All right, I'm going to go back up to the top. Okay. All right, so we would type this in. We can do parenthesis 0.10, 9,075, and the second parenthesis plus, we could do the 36,900 minus 9,075, close the parenthesis, times 0.15, then plus, parenthesis, 42,000 minus 36,900, close the parenthesis, times 0.25. This would give us $6,356.25 in taxes. Now, it asks us here, how much would she have overpaid had she simply paid 25% of her taxable income? So first, let's take the $42,000 and multiply by 0.25, because that's what they're basically asking us. So we'll go down here So we have 42,000 times 0.25. So that'll be $10,500. So to find out how much she will overpay, we'll take the $10,500 minus the $6,356.25. So we had 10,500 minus $6,356.25. So this person would have overpaid $4,130, well, actually $43.75. So it'd be $4,143.75, which would be what was overpaid. That's quite a bit of money. Okay, number 4. It says, use the tax bracket info on the previous page. If Mr. Brown believes the tax table, will he pay too much or too little, by how much? Okay, first of all, we have this tax table here. It says that the taxable income is $26,250. Okay, he follows 2 easy steps. Okay, so we could look over here. They're saying at the 26,250 mark, they're saying this is his taxable rate. This is how much he would have to pay, which is the $34.88. So let's write that off to the side. $34.88. Okay, we got that off to the side. Now we're actually going to do our calculations like we did in problem number 2. So we know since he's single, going back here, remember he has 26,250, so he's only going to end up in the 15% tax bracket. So it'll be 10% times the 9,075 plus, remember he ended up in the 15% tax bracket, so he'll take his 26,250 minus the 9,075 and multiply that by the 15%. Now, we'll put this in our calculator because it makes it a lot easier. So we have 0.10 times the parenthesis 9,075, and then plus parenthesis 26,250 minus 9,075, and then multiply that by 0.15. So this person would pay $3,483.75 in tax by doing it the way we did in problem number 2. So we're asked here, will he pay too much? You can say yes, he will pay too much using the tax table. So he would pay, now we would have to take the $34.88 that we listed here minus the $34.83.75. So he would pay $4.25 more. Now I know that doesn't seem like much, but you know, when it's your money, you want to spend as less of it as possible. Okay, now we go here to the back. It says, what would happen to you if you fail to pay your taxes? Excuse me. Say, what would happen to you if you fail to pay your taxes? Discuss, and if you're able, maybe do a little bit of internet research. There's a few things. You could be fined. You could have a lien on your property. And have wages garnished. credit rating will be affected. And then finally, you can go to jail. All right. Now we come here to the last portion of this exercise. If you look down here, it says, where do your tax dollars go? While paying taxes really sting, it can help at least some to know exactly what those dollars are accomplishing. The government maintains a website, the link is listed on the graphic below, that illustrates where federal tax dollars go. And for people that stink at percents, which of course does not include you, it's possible to just enter a taxable income and see how the money gets divided up. But we don't need that. We could just use the percents. Now it says if you paid $6,500 in federal taxes in 2014, how much of your money went to education and job training? So first of all, it told us we paid $6,500. So now we go here to this table for education and job training, which is here. And it's 3.59%. So it'd be 0.0359. So we'll multiply that. So we have 6,500 times 0.0359. So this would be $233.35. That's how much will go to education and job training. Now it says in 2014, the president paid $93,362 in federal taxes. How much of his money went to national defense? So we know he paid $93,362. And now we will go to national defense, which is 23.91%. So we have 0.2391. So we'll multiply that out as well. So 93,362 times 0.2391. And that would give us $22,322 and about 85 cents. That's how much of his taxes went to national defense. Now we are done with 3.5 and 3.6. So as you know, you do have your check assignments to complete for 3.5 and 3.6. You could actually do both today. I have both of them open today. But if you can't get to both, you at least need to do 3.5's check assignment. And that is definitely due by the end of the day today. 3.6, you could do it today, or is due by tomorrow night. It's due by tomorrow night at 11:59 p.m. for the 3.6. Now your project 3 is going to be due this Saturday, December 5th. So please remember to turn it in. And if you have any questions, feel free to contact me. Have a wonderful day.